Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, who is, of course, the founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, let's start off with the most recent trade, which was Aspen. And you'd waited a couple of weeks to get out of the blocks, and Aspen was a trade, and it worked out very well for you last year. And then a couple of days ago, I noticed that, well, in fact, I suppose yesterday, it looked like it was almost going to breach your stop loss. So somewhat maybe a shakier start than you would have liked for the portfolio.
Yeah, certainly it is. I know you talk about this being the warts and all trading show, and it certainly is. I mean, I know I came here last week and I said I like the look of African rainbow minerals, and I like the look of Kumba, and I like the look of Aspen, and I sort of thought to myself, I'll pick one of these, and which is likely to be the safest, and I thought Aspen was it. But in retrospect, I probably should have chosen one of the others, because the others have performed quite well, and Aspen's really been quite pedestrian. So if we have a look at it quickly, I mean, it's still fine. We're still in the trade, but it's been a bit tedious over the past week. If you look at the chart of it that's up on the screen at the moment, what you can see is we had this uptrend, and that goes all the way back to August of 2011, actually. So it goes back beyond the scope of this chart. But it's a very nice, neat, tidy upward trend. And each time the stock gets to that uptrend, it seems to find support, and it seems to generally push higher. And my thinking was that it would do that again here. So I bought for our portfolio last week, I bought 625 CFDs at 165 Rand with a stop loss at 159. Now, yesterday it traded down as low as 160 Rand at one stage during the day, and then it actually was quite strong into the close. And today it's been bumbling along at about 165 Rand again. So it's pretty much at the same levels where we entered the trade. We haven't been stopped out. We still are in this trade, and it still looks okay to me. You might argue that we're seeing a possibility of a small head and shoulders forming at the top there now. Let's see if that turns out to be the case, then our stop loss will catch us. But what could just as easily happen here is that could be a head and shoulders continuation pattern, which in fact is quite bullish. So let's see. We're in the trade. Our stop loss is at 159. We risked 1.5% of our trading capital on this trade, so it wasn't a big risk that we took. And I'm going to stick with it for the time being. It still is quite oversold on that stochastic oscillator. I still think there's hope for this trade. So let's stick with it and see how the week plays out from here.
Yeah, okay. So maybe not as exciting a start as you would have wanted. And just on that note, it's been quite interesting to see the JSE scale record highs, and yet effectively the trade that you're entering into this week is kind of a hedge against some sort of a pullback.
Yeah, it is. We're doing another one of these dreaded put spread option structures, which I did 2 of them last year, and I know these things are quite complicated, and I know a lot of the viewers might find it a bit difficult to grasp, but I'm going to do my best to explain how this thing works. Effectively, yes, it's a structure that I'm putting in place to try and profit if we see the market pulling back between now and June. And it's relatively cheap protection that I'm buying. Let's get into it, and then we can have a look through and try and explain the whole situation around this. I mean, first of all, I've got a chart here of the JSE Top 40 index. Now, the put spread option structure that we're doing it's an option over the top 40 futures. Okay. So you've got your futures contract, which mimics the JSE Top 40 index, and we are now doing options contract over that futures contract on the Top 40 index. So it's a derivative on a derivative, if you like, which is where the complications come in. But I'll make it as simple as I can. If we look at this Top 40 index, what we can see is we've got a very steady upward trend going all the way back to the lows of March 2009. Those were the lows when we were all panicking about the bottom of the financial crisis, basically. And since then, the market has pretty much doubled since those levels. And you can see that uptrend joins all the lows that we've seen over the last 2 years on that chart. We're getting quite far away from that trend line at the moment. We're trading up at about 36,300 now on the futures. And this trend line comes in at about 32,500 at the moment. So quite a long way below where we are. I mean, that's about 10% down from where the market currently is trading. Now, the question I have is, we've gone up, since July last year, we've gone up basically in mostly a straight line, 25%. Is this likely to continue, or are we at some stage going to see some sort of a correction in the market? And I tend to get the feeling that we are getting a little bit too exuberant at the moment. Yes, there's a lot of good news out there, and there's a lot to be bullish about, and I am bullish for the year ahead. But markets don't go up in a straight line forever. They have ebbs and flows. And at some stage, I think there is a possibility that we could see this market have a little bit of a correction. I'm not turning bearish, but I'm trying to be realistic here. And I think the possibility does exist that we could see the market pulling back into that circled area there at some stage. And what I want to do now is try and put some sort of an option structure in place that will allow us to participate in that if it should happen. But it's not going to cost me much money if I'm wrong.
And I suppose the other advantage it gives you is that knowing that you have some sort of a hedge against a pullback in the market, it probably gives you more security in going long of individual shares, because you feel, well, if the market tanks, then you've got some sort of a support in place.
100% right. I mean, last year we did a few of these structures, and what it did is having that protection at the lower levels gave me the confidence to buy a bit more aggressively and to take advantage of the long side of the market. So I've effectively put this insurance in place, if you like, to protect us if the market should fall. So it does give me a little bit of confidence, and it also gives me the ability to profit if the market were to take a bit of a correction from here.
Okay, so that's sort of the broad outline of the kind of trade that you're doing. Let's get into more of the detail.
All right, let's look at the mechanics of how I construct this thing. So what we've got here is a graph where on this y-axis over here we've got the profit and loss, and along the bottom axis here we've got the levels of the top 40 index. At the moment we're currently just above 36,000, which is above where this level is here. So there are two components to this put spread option structure. The first is that I've bought an option on the top 40 with a strike of 34,000, right? For that, I've paid 5,692 for each option.
Okay, so you bought two options.
I've bought two of them. And each one of these gives you exposure to 340,000 Rand worth of market exposure. So the fact that I've done two of them means that I've got exposure to 680,000 Rand worth of exposure to the top 40 index.
So it's basically 10 times gearing.
Yeah, correct. It's 10 times gearing. And the cost that I've paid is effectively the 5,692. I've paid that twice because I've done two of these options. Therefore, I've paid 11,384 Rand for this option structure. So if you look at the payoff of this particular option, you can see here we've basically got a negative profit and loss situation there down to 34,000, where we've paid away 11,384 Rand. Below 34,000 then, it starts to make a profit, and you can see that it continues to make profit the lower the market goes, and it will continue to make a profit all the way down to zero. Now, in reality, the market's not going to go to zero. So why should I pay for something that's giving me the participation all the way down to zero? So what I therefore do, in order to help me offset some of that cost, I don't want to pay the full 11,000 Rand away. What I then do is I sell away some of that downside.
Okay.
And by doing that, I've actually then sold a couple of put options with a lower strike. And in this case, I've sold options with a strike of 32,000. And because I'm selling those options, I receive a premium. The premium gets paid to me.
Yeah.
In this situation, I've received 2,347 Rand on each of these options, and I've done four of them in this case. So I've sold twice as many of these lower striked options as what I bought of the higher striked options.
Presumably to a very bearish buyer.
Well, I've done it with a market maker. I've done my market maker is Nedbank in this case, and they've been the people that have structured this deal for me. For that, I've received a premium of 9,388 Rand for those four put options, and there you can see it. So the blue line is the payoff profile of the short put option structure. I've received 9,388 Rand over there, which is showing as a positive, as a profit in my P&L graph, and then I start to lose money on that below 32,000. Okay. So in order to achieve the net payoff of this put spread option structure, you overlay these two graphs against one another, and you get that yellow line. So if I tidy it up a bit, what it looks like is that, and in effect, this is the net result here. You can see that my net result is that I've paid away 1,996 Rand to get this to put this structure in place. That's like my insurance premium, if you like. I've paid that away. I'll lose it if the market stays strong. My maximum profit will be achieved at a level of 32,000 on the top 40 index, and my maximum profit that I can make in that case is 38,000 Rand, which is about 15% based on our capital that we've got to trade with.
And the strike date is June, but
yeah.
You could exit the trade or the structure beforehand, couldn't you?
I could, but there's going to be various pricing vagrancies along the way. There is volatility and all sorts of additional issues that come into the pricing. So it's not always as simple as this. This is what the payoff would look like on expiry, which is the 20th of June in this case. So what I've got is that green pyramid over there is effectively our profitable area. Mm-hmm. You can see the structure is profitable between 34,000 and all the way down to 30,000, and that's a range of around about 12% on our market. And below 30,000, then it starts to lose money, and that's what I always refer to as the danger zone, because that's where it can get a bit nasty. But if that were to happen, I've got methods in place where I can actually hedge that downside as well.
And of course, if it remains above 34,000, then so be it.
Exactly.
It's a strong market, and you've paid away the 2,000 Rand.
That's it. So I've paid 2,000 Rand. It's not even 1% of our trading capital that we've got that I'm paying for this participation. But basically, this structure gives us profit if the market were to fall 6% from the current level, anywhere down to 17% from the current level. So it's quite a nice window that we've got where we can participate. And if we look at our top 40 chart again, bring it back as we did earlier, let's overlay this option structure on this top 40 graph and see how we look. So there's our top 40 chart. Basically, those are the important strike levels that we've discussed: 34,000, 32,000, and 30,000. Now, we're sitting up here at the moment at about 36,000 on our top 40. But if we were to pull back into this region over here, between 34,000 and 30,000, you can see the put spread option structure payoff illustrated over there. Whilst the market is above 34,000, I lose that premium of nearly 2,000 Rand. At 32,000, I can make the maximum profit on this structure, which we said was 38,000 Rand. And then down below 30,000, I start to lose money on this structure again. But anywhere in that area, between 34,000 and 30,000, that's our profitable area on this structure. And to me, it's quite a nice hedge to have. We effectively bought ourselves a bit of insurance here if the market should pull back.
Just a last comment on this trade, Garth. It's quite complicated, so it's for sophisticated investors. Is it necessarily for the average retail investor, and can they actually organize a structure like this if they're not quite a big trader, I suppose?
Yeah, no, it's a good point that you mentioned that, because I've got two disclosures to make here. The one is that unfortunately these options are not as easily tradable to the retail market as what I've made it seem here, and particularly not in the sort of size that I've done for our portfolio here. I was able to do this because it was part of a larger structured trade that I was doing for myself anyway, and I sliced a piece of it off and allocated it to the TV show's portfolio. But typically the market makers won't be willing to make you a price on such a small trade like this. That's the one thing. Unfortunately, I wish the market for retail options was more liquid, but it's just not in South Africa. It's unfortunately the case. The second disclosure is just to make people aware, and I've said it already, but I'm going to say it again. I'm not turning bearish on the market. I'm not a bear. I'm by and large bullish for this year, but I'd just like to have this protection in place in case, because the markets can always surprise you. And I think there is a possibility that between now and June, we could see our market stage a 5 or 10% correction. And if that were to be the case, this structure is perfectly positioned for us to participate in that.
Okay. Garth, very quickly, before we get to your next course dates, what does the portfolio then look like given these two recent trades? All
right, it looks like this. There's our Aspen trade that we did last week. We've got a tiny mark-to-market profit there of 220 Rand. And then this put spread option structure that we've talked about today, I've accounted for the full premium here. So we've lost, well, not lost, but we've paid away almost 2,000 Rand to do this. So our portfolio is sitting at 248,000 Rand. We're slightly underwater at this stage, but it's early days yet. And I'm happy with where we're sitting at the moment.
Okay, so down 0.8%. And then very lastly, course dates, 2nd of February and a couple in March.
Yeah, I've got one this Saturday. There's still 4 places available this Saturday, the 2nd of February. And then I've got another one on the 2nd of March in Joburg and the 9th of March in Cape Town. So anybody that's interested in attending one of these courses can email me, garth@traderscorner.co.za, and I'll send you the details.
Okay, great. Garth, we have to leave it there, but thanks as always for joining us. That's Garth McKenzie, founder and editor of Traders Corner.